We'll finish our analysis of the operating efficiency ratios by looking at the cash cycle, and we did cover this in chapter 20. And what we looked at was the cash cycle is basically two ratios added together. The first one is the ratio that looks at how long does it take to turn stock into sales. That was measured by our stock turnover ratio. And then for those customers that buy on credit and become debtors, how long on average does it take to collect amounts owing from those people, which is called our debtors turnover ratio. And together, the cash cycle is simply the total of those two numbers. And what does it represent? Well, the way our business runs is it buys stock on credit from a supplier. It then sells that to customers, and possibly on credit. It could also be for cash. And we measure that with what's called stock turnover in days. So for the cash sales, we've already got the money, but for the credit sales, we need to collect those amounts owing from debtors. And we measure that with our debtors turnover ratio. So together, if we add those two numbers together, that completes that triangle, and we end up back at step number 1, which is buying more stock, and that's the total of the stock turnover plus the debtors turnover is how many days it'll take to get back there. And all we do is continue running our business by buying more stock, selling it to customers, and then collecting the amounts from debtors. And then we buy more stock, sell to customers, and then collect amounts owing from debtors, and so on. So if we had the following ratios, a stock turnover of 38 days and a debtors turnover of 24 days, the cash cycle is simply those two numbers added together. So we get 38 and 24, which is a total of 62 days. What does that mean? It means that on average, it's taking us 38 days to turn purchases of stock into sales, which is our stock turnover ratio. And then once those goods are sold, it's going to take another 24 days on average to collect amounts owing from debtors. So together, that is a total period of 62 days for our cash cycle. If the cash cycle goes from 62 days down to 54 days, we would say that's a good trend. That's because we're taking less time to convert stock into cash by selling it and by collecting amounts owing from debtors. And if it increases to 75 days, that's a negative result because we're taking more time to get the money from stock. The importance of creditors and the cash cycle is that there's a bit of a relationship, because when we buy stock on credit, the first thing we actually want to think about is before we sell it and then get amounts owing from debtors, we might want to think about the fact that once we buy stock, assuming it's on credit, which we'd like it to be, because that gives us time to sell it before we have to pay for it, we are going to have to pay back creditors. And what we learned was that there's a ratio called the creditors turnover which measures that. And let's say it's 58 days. Well, now we kind of have a race. We are paying back creditors for stock on average every 58 days. And that means we've got to get around this triangle here in probably less time than 58 days. And the reason is we need the money to pay back the creditor for the stock that we're actually buying from them. So in this case, if we had a stock turnover ratio of 24 days, and then we collected on average from debtors every 27 days, that's a total of 51. And what we'd see is that when we buy stock, we are paying back creditors on average in 58 days. And with selling it, we're actually a little bit more efficient. We're able to sell it within, I think it was 24 days, and then collect the amounts owing from debtors in 27 days. That's a total of 51. We're actually getting the money for the stock that we've sold before we're actually paying back our creditors, and that's a good result. What that means is we've got 7 spare days up our sleeve on average to use that money to pay back the creditors for the stock that we just sold. However, one thing we said was, well, if we make creditors turnover go down, that can actually be a bad thing. If it goes from 58 to 45 days, the problem there is there's now more pressure on this triangle to be smaller. So we now need to try and sell and collect amounts owing from debtors in less than 45 days. That's very difficult. So maybe our stock turnover is 26 days and our cash collected from debtors on average is every 32. Well, that's not good. That's a total of 58 days. So the problem here is we're buying stock and paying it back in 45 days, which is better than last year. So that maybe means we're going to get discounts and our suppliers are happier. But the negative of that is that we're actually creating more pressure for ourselves because we're not selling stock for 26 days and then on average getting the amounts from debtors for 32. Well, the problem there is there's 13 days where we're paying creditors back, but we don't actually have the money from the stock that we're paying for, that we just sold, or that we're trying to sell. And the problem there as well, we're going to have to find money from somewhere else to pay it. We can't actually pay back the creditor for that stock with the money that we've got from selling it.